What's up, everybody? Welcome to another episode of VAR, Video Assistant Referee, where we go around reacting to social media tax advice and we determine if a yellow card should be given, a red card should be given, or no verdict because maybe the referee, the on-field referee, made the right decision. So we would vouch for it and agree with it. If we are meeting for the first time, my name is Ronnie Fogan. I am a Canadian and US CPA whose sole purpose is to help my creators keep more after-tax cash, maximize their ROI. Through effective tax planning over the years, we've helped creators save 4 to 5 figures in taxes. We have a new video that we're going to check out today, so without further ado, let's hop into it.
If you're incorporated, how do you take money out of your corporation to pay yourself? I just wanted to dive.
First of all, I like the setup. Whiteboard is always a green flag when tax advice is being given. I feel like people who use whiteboards, they actually have attention to detail, because think about it. You have to sit down, write that out. She already got different colors, salary in blue, dividends in red. Like, I have high hopes for this one.
If you pay yourself through a salary, you're essentially paying yourself as an employee of the corporation. If you pay yourself through dividends, you're paying yourself as a shareholder of the corporation. Now, both.
I like that she's distinguishing that, because naturally the nature of who you are as a party receiving the income is going to yield different tax implications, different operational implications, and different compliance implications as well. So I like that she makes that discernment, right? Like, if you're earning a salary, yes, you may be an owner manager, as in you own your corp, but you're also an employee of the corp. But the salary puts you into that employee category, whereas a dividend puts you in a shareholder category, because employees don't get dividends, right? Only shareholders can get dividends. So great point. It might seem fickle. It might seem like, oh, like we don't need to know that necessarily, but you do. And, it's a 3-minute video, so I feel like she might elaborate on why we need to know that in the future.
Both of these, they kind of have pros and cons. One's going to give you more of a long-term benefit. The other one's going to give you a little bit more flexibility and freedom. So
Facts. Salaries, they're tougher to set up. You pretty much have to register for a payroll account with the CRA to make that work, and you have to have preset payments, have tax withheld, have CPP and EI withheld. So it's a lot more difficult, but it's rewarding for a multitude of reasons. That's why people still do it. Whereas dividends are really easy, right? If you're the owner manager and you want to pay yourself a dividend, most people just e-transfer themselves. Hopefully she discusses this, but that's not sufficient. I've had to tell multiple people that just e-transferring yourself is not sufficient, especially if it's a corporation. You're going to need resolutions and meeting minutes for that. But it's a lot easier, right? Like, whenever you need money, boom, e-transfer from corp business account to individual business account. So great points there on flexibility versus the difficulty and challenges with the salary.
because it's income, it's going to create RRSP room. Secondly, it's going to build.
All right, that's a good point. I don't know why she didn't elaborate on that, but that's really key. And that's one of the reasons that I was saying that, even though a salary is tough, there's a reason why people still choose to pay themselves a salary. Salaries are kind of the prehistorical way to pay yourself, but it's still relevant. And as she says, RRSP room is really important. Like, your contribution room is based on your prior year's earned income, and your earned income is going to be a combination of your employment income, so T4s, your salaries, as well as self-employment income if you have like a T2125. But in this case, if you have a corporation, the business side is going to come from the corporation, which would be a T2 return, aka your earned income and your contribution room from the RSP will solely come from your salary, which is why it's important for you to pay yourself one. If you want to have good retirement income once you're retired at a lower tax bracket, that's when you want to maximize and capitalize on the RSP. So great point there.
Secondly, it's going to build your CPP. And third, it's going to be deductible to your corporation.
Deductible to your corporation, like your salary is a tax deduction, and off the bat, you might be thinking, okay, like I'm saving on income, I'm saving on taxes by doing this, because it's actually going to be a tax deduction where, if we're assuming we haven't gone to dividends yet, but dividends will not be tax deductible, right? And people might say, well, if I'm getting a tax deduction, then naturally on the salary, I'm netting out, I'm having net savings on my taxes, but that's not always the case. And one thing I want to preach on this channel, one thing I want to preach in my community is understanding different tax rates, different marginal rates, and creating and seeing the arbitrage between them. If we're in a corporation, and say our tax rate is either 12% or 27%, right? We're not even going to try to play with the active business income limit, whether you make less than half a million or more than $500,000. Your tax rate, let's say the peak, is going to be 27%. Would you want to take a deduction of a salary when you know that your personal tax rate is going to be higher than 27%? You wouldn't, right? Because you're shifting a deduction equal to your salary multiplied by your corporate tax rate of 27%. But then you're offsetting that with an increase in taxes equal to that same salary amount multiplied by a higher marginal tax rate, right? So whenever people say, hey, like, salaries are the way to go because you get a deduction, there's a lot of people who are, they lean more one way and the other, when I feel like tax planning and tax advice is always, it's fluid. It depends on the person. For most people, your goal should be to keep your salary from your corp real low. Like, try to stay within the first two tax brackets, right? 15% federally, 20.5% federally. You should never even try to get into those higher rates at the personal level. So that, say you're a wealthy content creator and you're earning over the active business income limit of $500,000, your excess is now going to be taxed at 27%, but you can take that deduction from the salary because your tax saving is going to equal to that salary times 27%. And you're going to be in a net saving position because the offset is going to be an increase in taxes personally of that salary multiplied by a lower tax rate than 27%. So that's why it's so important to understand arbitrage, because it's never going to be pointing one way towards salary or one way towards dividends. It's going to have to be a combination of both. You're going to want to make sure that your deduction is coming from a position where you're in a higher tax bracket and you're shifting that income into a lower tax bracket. All right, this is called income splitting or income shifting, and in this example specifically, we're referring to shifting income from your corporation to yourself when we understand that the corporate rate is higher than the personal rate. And quick caveat, I do also want to mention, because my community is inclusive of American creators as well, on the US side it would be the same scenario. If you have your C Corp and you know that your federal tax rate is 21%, you want to make sure that to take that deduction from your salary, ensure that your personal tax rate is lower than 21%, all right? So it starts at 10, then it goes to 12, then it goes higher and higher. So make sure it stays below 21% for this to make sense for you to pay that salary, all right? So always have that variation, always play around with the arbitrage and make sure that you're going to come out in a net tax saving position. And naturally, if you need help on this, reach out to a professional.
Because, you have income, steady income, banks like to see that. So if that's something you are looking for, then that would be an advantage as well.
The salary helping with mortgages is a really good point that she brings up, because banks, we're not going to talk about all types of banks, mainly the A tier banks like Scotia, RBC, and all of them. They're going to be looking at your salary to determine if you're able to hold their mortgage. Now, if we're going to B lenders, right, private lending and stuff like that, they're going to be more understanding of the fact that you have a business and that you may have written off certain things to reduce your taxable position, to reduce your tax position. And then they will normalize your earnings to make sure, like, hey, for example, let's get access to your bank statements. Let's see all the deposits that came in, and we're going to use that as a factor to see if we give you a mortgage, right? So it's not the be all end all. So please don't let that affect your decision to pay yourself a salary, especially if, when we're looking from an arbitrage perspective, you're actually increasing your tax owing by paying yourself a salary. We want to make sure that we don't let the mortgage situation factor in. The tax planning is holistic, right? It comes from a standpoint of, hey, if someone is coming to you, if a creator is coming and saying, hey, I want to buy a home, you have to see if it makes sense for them to pay themselves a salary to justify it to the bank, and see, okay, well, the additional tax that they're incurring, does that make sense? Does that pay off compared to the additional interest that they would pay if they went to a lender that could factor in and normalize their earnings from the business so that they don't have to issue themselves a salary for that deduction? So great point on her front, because the mortgage is a factor when paying yourself a salary, but it is not if we were to rank the tiers of effectiveness of the salary, I would put the mortgage where she's actually put it, which is probably like the fourth most important thing. A really good video so far. Is really introspective and really going. She's not missing any point at all. Like I think everything is covered in her whiteboard, which is pretty cool to see.
So now let's hop over to dividends. So like I said, this you're essentially paying yourself as a shareholder of the corporation. So some pros are you're going to be at a lower personal tax rate. There is no CPP. Now this can be a pro or a
Let's actually dive into that. Lower personal tax rate is true. We just have to make sure we clarify why that is. And that's why, like with tax planning, we have to look at things from both the lens of the corporation and the individual, the content creator himself. So, yes, there's a lower personal tax rate and is due to a tax credit, a dividend tax credit being issued. And that dividend tax credit does not come out of thin air because the CRA and the IRS as well, I'll just lump them both in there. They don't give incentives for no reason, right? Everything that we see as a tax benefit, like, oh, we win at this, like there's no freebies. Like they really want you to do it. And they're giving you this dividend tax credit because they're saying, well, hold on. We already taxed you on this amount because the dividend was not deductible at the corp level. So they're going to issue you a dividend tax credit. And if you're wondering what that dividend tax credit is equal to, that dividend tax credit is equal to the amount that would make it so that you paying yourself a salary and you paying yourself a dividend were the exact same so that it didn't matter what you did. It's a system called the integration system, and that's what the CRA chose to implement. And the dividend tax credit, if we factor in the tax paid at the corp level for that dividend, for that income that ends up being a dividend, and we look at it from a personal perspective and we add them together, it's going to be equal, theoretically, or close enough to the tax paid on the salary. Now, tax planning comes into play because even though I say that the CRA intended for that to be the case, it is not always the case. And by tax planning and specifically looking at timing differences, right? Like at the beginning of the year, at the beginning of the fiscal year, you can plan a salary. You can say, I want this base salary because I know this is how much I'm going to pay on this no matter what. As the months go by, as the quarters go by and you tax plan, you can then start sprinkling dividends here and there. You can start sprinkling bonuses here and there. And if you're in a really, really high income threshold within the corp that you want to pay yourself, consider loans so that they're not taxed to the government. So just a little caveat there to show why it's a lower personal tax rate. It's a bit misleading because if you were looking holistically as the owner of the corp and the individual themselves, they're paying the same amount of tax relatively as they would if they were to have paid themselves a salary of the same amount. Great point by her. It is technically a lower personal tax rate, but if we do factor in that corporate tax, it's all the same.
Con, depending on how you look at it, it really depends on the person. And third, it's easier. You're not going to have the payroll. Some things to note, there's going to be no RR.
I think we could pretty much stop here. I think this is a great video. The dividend part is pretty much like the opposite of the salary part, like no RSP room, no CPP, not deductible to the corp. So like all great points. I think this was a great video. Overall, the VAR verdict in this one is that we agree with the on-field decision. I don't think there was anything warranting a yellow card, anything misleading, or anything factually, incorrect or warranting a red card. So, kudos to her on the video. Definitely loving the use of the whiteboard. If you guys are enjoying this type of content where we review social media, tax advice, leave a like, comment down below. Leave a comment and tag me in videos that you want me to feature on VAR for the video assistant referee. And if we're meeting for the first time, my name is Ronnie Foguin. I'm a Canadian and US CPA, and my sole purpose is to help content creators maximize their wealth, maximize their after-tax cash through effective tax planning. It's been fun. I'll see y'all in the next video.